Now, speaking of reports that could be market movers or inflection points, Apple, one of the names reporting after the bell today. We got Steve Kovac out at Apple HQ ahead of that critical print. A lot of eyes on this, a lot of expectations for Apple to maybe clarify its AI strategy, Steve.
Yeah, we'll get to AI in a second here, Frank. But first, let's talk about tariffs, because that is another big thing that's been weighing down on the stock all year long, why it's been underperforming most of its Mag 7 peers. We know there's going to be a $900 million impact from tariffs in this June quarter, but everyone wants to know what that looks like for the next rest of the year, rather. We heard the mitigation efforts from Apple last time that they're going to focus more on bringing iPhones from India to the United States, which has that lower tariff rate. Still not enough to fulfill all the demand in the United States. We're still going to get iPhones from China at that higher tariff rate. So what do margins look like moving forward? We're going to look at the guidance for that on the call. And whether or not, excuse me, that tells us there might be a price increase with those next iPhones that come at the end of this quarter that we're in right now, or if Apple's just going to go ahead and eat those costs. So those are a couple things to look out for. And then on the AI front, like you guys have been talking about all segment now, the enormous spending from the peers. Microsoft on pace to spend $120 billion in capital expenditure. But for just one example, we have not seen Apple come anywhere close to that. We know they had those big delays for their artificial intelligence products. They say it's going to come next year, and we're going to hear a lot of questions, I assume, on that earnings call for Tim Cook and the rest of his team, why they're not spending so much and what makes them confident that they have a good AI strategy and team in place to compete with these peers who are moving so quickly, Frank.
Our Steve Kovac at Apple HQ. You can have the numbers after the bell. Steve, great to see you as always. Following some of Steve's comments about Apple after the bell, I'm going to go over to you, Josh. You're an Apple shareholder. Is this a tense moment for Apple shareholders? I mean, especially after these blowout reports from Meta, blowout reports from Microsoft, blowout reports from Alphabet. Is there potentially an inflection point for this stock to take a serious downturn just on disappointment?
I don't think this time. I mean, anything could happen. My bet would not be a serious disappointment. I think the shareholder base is already disappointed, and they've been disappointed for a long time now. The last quarter, Apple reported with cash flow growth in the double digits on a year-over-year basis was all the way back in Q1 2024. Here are the numbers over the last 5 quarters, and this is why it's hard for them to disappoint. Negative 1.5%, positive 0.46%, positive 3.6%, positive 4.1%, positive 6.1%. That's EBIT growth year over year. These are not great numbers for a Mag 7. The thing is, this is the only gigantic company that is almost adamant about not raising CapEx. Full CapEx spend this year is supposed to be $11 billion. For Apple, it's literally pocket change. You're talking about a company with hundreds of billions of dollars at their disposal to do whatever they want with. And what they seem to want to do is a buyback, tiny dividend, and just business as usual in the midst of all of their competitors going absolutely crazy. 20% of revenue, 30% of revenue, Microsoft almost 40% of revenue, and Apple's not doing it. Yeah. And so if you want to be a contrarian in the Mag 7, if you want to pick the one company that doesn't believe they need to act like this, buy Apple. Yeah. And from a disappointment standpoint, no one's expecting anything. It's a no-growth business. We all get it, and yet we're valuing the stock here anyway because of the stability.
You said it. Yeah. No one's expecting anything here, and that's the kind of thing I like. Now, I'm not sitting here and adding Apple right now. We're really well underweight Apple in our portfolios. We've about weighted 3.5% in our portfolio. I want to buy Apple. I'm thinking that, listen, they underwhelm, but a lot of the negativity is priced in. Actually, today, it is making a new low against the NASDAQ on a relative basis, against the Qs, the lowest it's been relative to the Qs since the summer of 2020. I would like to see Apple 195, 190 range. I would probably we'll double my position in it and get it up to
if it falls down to 195.
If it falls down to that range.
Malcolm, I want to come to you. By the way, can we show a year-to-date chart of Apple right now? You were talking about stocks that are potentially falling knives. If you look at the year-to-date chart of Apple, it's down double digits year-to-date. Malcolm, I'm going to come to you. Are we sure this isn't the next falling knife? Steve Kovac hit on some of the tariff impacts, just some other issues with the company, innovating when it comes to artificial intelligence. When you look at this chart, are you seeing signs of a turnaround coming in the near or the even medium term?
Yeah, I think rather than listening to this earnings and finding out how many fewer iPhones they sold in the past quarter versus the previous one, what really is going to matter for Apple shareholders in the near term is that any day now, a judge is going to deliver a ruling on whether Google gets to keep paying them to be the dominant search engine on their platform. And that's what's really going to matter, because just that one payment alone represents something like 10% of Apple's earnings. So that going away probably does get you into the 190s range, into the price target that a lot of folks like me have been looking to add additional shares of Apple to their portfolio. But to me, if I'm Apple and I really want to free ride on what the momentum is right now, I'm not necessarily chasing AI. I'm looking at what's been happening in stable coins and fintech, and looking at the fact that 2 billion people are walking around right now with my devices in their pocket and maybe figuring out a way to tap into some of the money they've spent on things like Apple Pay Later and others to add in those additional fintech features that would just be a thing to bridge that gap until people are really ready to upgrade for those AI features. Because if you were able to really tap into the Apple Wallet a little bit more, that goes to the services revenue, and that buys you time for people to stop questioning whether they should continue to hold your shares.
All right, I understand the thesis on a possible new line of business, but go back to the Alphabet part. So they lose, I think it's $20 billion in annual revenue if the judge rules against them.
Yeah.
And the stock falls down to 195, and that makes the company more attractive, Bill? Because you were doing a lot of nodding over there. What makes the company more attractive after they lose $20 billion in annual revenue?
Well, once the news is baked in, I mean, right now, they're already pricing in, like, not growing revenues to the extent that they have in the past. I mean, a lot of the negativity is being priced in. And you come from the school of, if all the sellers have already sold, who's left to sell? So I think a lot of that's really been baked in. And if they lose that revenue, the market's going to react. That could get us to 190, maybe a little bit lower real quick. But I'm looking at 190, 195 on a technical basis. There's a nice little uptrend that it's hanging. If it trades lower here, it's got to get down in that range. Negative news on top of that could exacerbate that downside. But I'm sticking with my guns, and I would look to be a buyer of Apple.
We also have Amazon reporting after the bell. Josh, you own this one. Obviously, the #1 cloud player. After blowout cloud results for both Alphabet and from Microsoft, it seems like there's a lot on the line when it comes to AWS and being able to not only meet the expectations but exceed them.
Yeah, we wrote this up as part of our Best Stocks in the Market series at CNBC Pro this morning. I own the stock. It's on our list. This is still below its February high. So if you go back to February 4th, the company was 2 days away from reporting earnings at a record high, $242 per share. Reported that number. The market didn't like the guidance. It was a good report, but the stock fell 4%. And then we got into the whole tariff trade war stuff, right into the teeth of Liberation Day. And this stock was in a massive drawdown. What's happened since April is a 25% recovery in the share price, almost back to those February highs, not quite through. What we wrote today is that if tonight's report shows they've been executing, which I think they have, you will see a new record high for the stock finally, after it spent the last, 5-6 months sort of like in a purgatory. I think the big number here is going to come out of Amazon Web Services, as it always does. The most exciting part of the story to me is the backlog of $189 billion, which I think is really the part of the Amazon story that should put it in the same conversation when we talk about Microsoft and Azure. It's a gigantic business. AI is going to be supremely important here. They are positioned to deliver AI services to more customers than anyone else other than Microsoft. And I don't think that that's really in the stock's price right now.
What's interesting?
So last thing, 36 times earnings, the lowest multiple you've ever been able to pay for Amazon's earnings since the company came public. Literally, it has never been. So I understand it's not growing as fast as it did 10 years ago. We all get that. Right. But you have never, ever had the ability to buy it at this valuation.